welcome to Market Domination Overtime. Stocks feeling the holiday cheer as the S&P 500 closes at a fresh record, suggesting a positive setup for a Santa Claus rally. For more on the optimism at play, let's get to FBB Capital Partners President Mike Muscio. Mike, it is good to see you. Let's start on the economic data, Mike, because we did get that read on the jobs market. Initial jobless claims, 214,000. That was better than expected. You saw the GDP print we got this week, Mike, of course. That was better than expected. Your take on the economy, Mike, I'm curious, where we are and where you think we're headed.
So the data would suggest that the economy is actually really strong, right? The GDP data, while it's lagged, this is Q2 data that we're just now getting yesterday because the government was shut down. That was a really solid number, 4.3% for the third quarter. The second quarter was 3.8%. So we have a 6-month period of time where growth in the U.S. post-Liberation Day has been 4% on average. So that's really solid in terms of fundamentals of the economy, of what's actually driving growth in the economy. The jobs picture has been a little bit more bleak on the whole over that time period in terms of job creation, and the unemployment rate has ticked up, but still in that 4.5% range, which over long-term time periods is below the long-term average. So things seem pretty solid. But there continues to be this conflict when we look at the economy writ large versus things like consumer sentiment, which we got some pretty punky data on that yesterday, where sentiment is pretty low. So as we turn the page on 25 and head into 26, it'll be really interesting to see what companies are talking about in terms of fourth quarter sales, fourth quarter profitability, and what the consumers said versus what they really did when it came to their holiday shopping.
That's an interesting point, Mike, and I hear you on the consumer, and I'm not discounting that. We have, issues of affordability. We know issues of economic anxiety. At the same time, listen, I referenced that Q3 print we got, GDP print. Household consumption, Mike, jumped 3.5%. I guess my question as an investor, do I follow the sentiment indicators, Mike, or do I follow the hard data?
Yeah, so for us, we're following the hard data of the underlying economy, and then checking our work is squaring that hard data with what is actually happening with companies. And there's long been this soft data, hard data kind of split in terms of, again, consumers, investors for that matter, saying one thing but doing another. And where the rubber meets the road there are going to be earnings, right? It's going to be earnings from companies that we all shop at around the holidays, whether it's from Nike to Walmart, from Target to home improvement center stores and for regular home improvement projects. And I think that's going to be the data that's going to be the tell. Are the figures that Wall Street is building in for 2026, which is about 13% earnings growth, are those numbers looking likely based on how 2025 ended? And I think that's what we have to pay attention to.
You highlight here, too, just talking earnings, Mike, you do mention the other 493 in the SPX. Their earnings growth, you point out, looking solid. I mean, what does that suggest to you about the bull market broadly, Mike? Does that suggest to you, okay, well, things are relatively healthy, resilient?
Yeah, it's a much more positive story, I would say, sitting here at the end of 25 than maybe the growth rates of these other 493 companies were a year ago. The 493 are on track to kind of almost 9% earnings growth for this year, which in any year is a solid earnings growth story. So we've had this kind of bifurcation of the Magnificent Seven and then everything else. The Magnificent Seven are still growing faster than that, and fast enough, in fact, to pull up full year 25 earnings towards around 12% growth. But 9% of those other companies is solid, and that would be a catalyst for further improvement, further higher prices for the market writ large, if share prices follow that earnings growth of the other 493 and we have broader breadth in the market, for sure.
Mike, you do say here, if we got that Santa Claus rally, trim equities, especially big tech, into strength. First of all, how come, Mike? Explain that to me. And then if I was to trim, what am I rebalancing into, Mike? Which markets, which sectors?
Yeah, so I just want to clarify. So you use the right word, trim, right? And we're not saying sell everything. And it looks like the Santa Claus rally is off to the races here. So that's great. We'll take it. But our position with investors, kind of all throughout the year, and this is, we're straddling 2 tax years here. If you've done really well in something, and that something now is a larger percentage of your portfolio than what your risk profile would say is appropriate, then it's a good time, particularly if you haven't realized gains yet year to date, to trim some of that back and take some of the proceeds and put it in other places of the market that maybe haven't performed as well, and rebalancing your balanced portfolio. For us this year, that's looked like a combination of investing in some international equities, which are a little bit closer to large value than the large growth of the U.S. market. And that's also looking at some of those other 493, outside of the Magnificent Seven. It doesn't mean sell all of your shares in any of those, individual companies, but look to trim, be opportunistic, trade out of the 30 multiple stocks into the 15 to 20 multiple stocks.
And finally, Mike, I have to ask you, just because it's been dominating headlines, the kind of blistering runs, Mike, we have seen in the metals with gold, with silver. I'm just curious, what message or messages do you think that's sending investors?
Yeah, we have a small position in gold for clients. We think that there's a central bank buying story there, kind of a size buyer, if you will, of central banks across the globe that helps support that trade, and that is a long-term investment. Silver, as you know, is up, I think, 2x plus of what gold is this year, and platinum is up big as well. We're not as participatory in that. I think part of what's happening in silver, vis-a-vis the ETF, is there's a little bit of meme stock frenzy there, and so I see that a little bit more speculative than gold. Excuse me. Time will tell.
Mike, great to have you on the show. Merry Christmas.
Merry Christmas. Thank you.
Coming up, what's ahead for a very divided Fed in 2026? Plus, with cybersecurity attacks getting more sophisticated, we have an expert breaking down how consumers can protect themselves. The new year will bring a new chairman of the Federal Reserve, but it comes at a time when the central bank is more divided than ever. Fed correspondent Jennifer Schonberger is here with more. Jen.
Hey there, Josh. That's right. This year, the Fed grappled with sticky inflation and a softening job market, causing stark divisions within the central bank over what to do with interest rates, given differing outlooks. That dynamic is likely to persist into next year and could grow even louder. Here are 3 things to watch. Number 1, President Trump is expected to announce who he will nominate to be the next chairman of the Federal Reserve early next year. That person will replace Jerome Powell in May. Former Fed Governor Kevin Warsh and National Economic Council Director Kevin Hassett are at the top of the president's list. Rounding out that list are Fed Governors Chris Waller, Michelle Bowman, and BlackRock's Rick Ryder. There are question marks over who the president will pick and just how loyal that individual will be to President Trump's desires for lower interest rates versus what the economy actually needs. That could amplify divisions. And that brings up the second thing to watch. Will we continue to see a divergence with sticky inflation and a softening job market, putting the Fed's 2 goals in conflict? And will that translate to further differing opinions about whether to hold interest rates steady versus cutting interest rates further? The new chair is likely to favor cutting rates further, but he or she could have a tough time gaining consensus if inflation remains elevated. Cleveland Fed President Beth Hammack, who will be a voting member next year, has already said she thinks that the Fed could hold rates steady for several months into the spring. At the same time, Dallas Fed's Lori Logan, who will also be a voting member next year, believes that the Fed has done enough for now. And with the Fed having cut 3 times already this year, many others on the committee feel that rates are at a good level right now. So dissents could grow even louder next year. And that brings us to the third thing to watch, which is that things could get messy as President Trump is likely to continue to push the central bank to lower rates. But a chair who may be in favor of lowering rates might face resistance from that committee and will be at the mercy of the other members and may not be able to deliver those rate cuts. Next year, Fed officials have penciled in just one rate cut and have signaled that after 3 cuts this fall, they are likely to take a pause come January. Josh?
All right, thanks, Jen. Great stuff as always. Appreciate it. Well, crypto miner Hut 8 on track to end the year sharply higher. It's after announcing a deal with FluidStack and Anthropic to develop an AI data center in Louisiana. Hut 8 CEO Asher Janut spoke to Yahoo Finance executive editor Brian Sazi about that news.
We think that the value of energy will continue to go up. And so for us, we had to be patient and figure out what was a fair deal that added value to our customers, but that drove a strong return to our shareholders. And so the announcement of our deal yesterday, we had actually 2 announcements. One was an announcement with Anthropic to have the opportunity to scale with them for 2,300 overall megawatts. Then the actual deal we signed itself, that was $7 billion, was only 330 megawatts, which is 245 megawatts of IT load. And so for 245 megawatts of IT load, we announced a $7 billion deal that had a financial backstop with Google. And so we're very, very excited because it's the first domino to fall. If we're able to continue to scale and build up to that full strategic partnership on 2,300 megawatts, we see a lot of growth upside for the company. And the deal overall, not only did we announce that Google was creating a financial backstop, we had great partners like FluidStack and Anthropic, but also that we had execution partners to deliver the data center, from JP Morgan to Goldman Sachs providing the financing, and to Jacobs Engineering and to Vertiv providing the contracting and the supply chain. This deal is fully packaged and signed to be able to deliver for the customer.
Yeah, Jacobs is really really one of those under the radar infrastructure plays. Really enjoyed following their story. For the average investor out there, Asher, why would an Anthropic need this much power? Break that down for us.
They're growing month over month. I mean, if you look at some of the public reports, their revenue has been increasing by $1 billion ARR every single month. And so as they continue to grow, they need additional compute to keep up with the demand of their users. And so they're one of the fastest growing companies in the world right now. And we'd like to provide our first infrastructure layer to be able to allow them to keep up with that demand and continue to build out those models and those inference and training solutions.
How important was it that Google backstopped all this?
Critical. I mean, without Google, we would not be able to get JP Morgan and Goldman Sachs to commit to balance sheet financing to be able to give us up to 85% of the actual cost to build the data center for project financing, and at a really low rate of SOFR plus 2.25% target. And so overall, the clarity of Google backstopping, and think about this, it's a $7 billion deal. That's roughly $450 million a year. $450 million on average a year for 15 years for Hut 8 transforms the business. You look at mostly data center infrastructure multiples trade at a 15 to 20x multiple. That's somewhere between $7.5 to $9 billion of overall value. You take out the build costs, you're at $5.5 to $7 billion of equity value creation. And so overall, we're extremely excited because if you think about the company today, 330 megawatts alone is worth more than our full market cap today. In addition to that, we own 60% of American Bitcoin, which is another publicly traded company we have with the Trumps. That's worth about $1 billion. We have about 10,000 Bitcoin on the balance sheet. That's worth another $1 billion. And then we have 9,000 megawatts, 1,000 that we currently operate, another 8,000 of new development megawatts that I haven't even counted. And so we're extremely excited about the company, its future growth potential. I think this is the first step in showing the market we have an ability to take a site from the very, very beginning on a piece of land that we find to bring it to a commercialized AI data center.
Asher, what's the next step? Because if I have this correct, you have a pipeline. What does that pipeline look like? And are you just on the cusp of announcing more deals like you just announced?
Yeah, so when we announced this deal, creating a program with partners that could scale is really important. You brought up Jacobs Engineering. They have 40,000 contractors and engineers. You have Vertiv, one of the best equipment manufacturers within the whole data center space. Obviously, Goldman Sachs and JP Morgan have some of the largest balance sheets as banks. So we put together a group of partners that we believed could scale with us in our development pipeline. And so we spent this whole year creating that foundation, find the right customers who had the demand as well. And now it's about repeating this program again and again and again to start growing the value of this company. And we're extremely excited. And we think if we're on here a year from today, we'll have had a lot of headway in the skill that we were able to deploy and develop to our shareholders.
The FTC estimated that Americans lost $12.5 billion to scams in 2024. That was a 25% increase from a year earlier. And in 2025, attacks are growing in scope and scale, even taking advantage of trusted sites like LinkedIn. One company trying to protect consumers is Push Security. Mark Orlando, Push's Chief Technology Officer, joins me now. Mark, it is great to see you. So maybe start here, Mark. As the year draws to a close, we're rolling into 2026, Mark. What are the big cybersecurity themes, Mark, we should be aware of? What are the big trends? Scale, for example, seems to be one you're highlighting.
Hi, Josh. Absolutely. Scale is really one of the biggest developments that we've seen, not only this year, but in the last few years, as the infrastructure behind these types of attacks gets easier and easier to stand up and operate. I think we can expect the scale of these attacks to continue growing exponentially. We've also seen the sophistication of these attacks really getting higher and higher. You mentioned exploiting legitimate sites and services like LinkedIn, but we're seeing that across the board, whether it's social media networks or sponsored ads in Google results. Attackers have come up with some very creative and sophisticated ways to deliver these scams and these attacks to unsuspecting users.
It sounds like, Mark, you're also highlighting how more attacks are happening inside the browser. Why is that, Mark? I mean, just technically speaking, how does that help the attacker?
Sure. Well, the browser has really evolved from a tool that we use to view web pages to, essentially a platform that runs software on demand. I mean, this is where, work really happens these days, including, where users are logging into all of the various accounts and services that we use on a daily basis. So attackers realize this, and they have kind of shifted away from different areas of the network like email, or strictly web access that's fairly well defended into the browser, which is somewhat less well defended, certainly an area where most organizations don't have great visibility into what's going on and how users are interacting with websites. So attackers have realized this. They've shifted focus to doing more in the browser, where users can be tricked into doing a variety of different things, giving up information that maybe they shouldn't, logging into websites that they shouldn't, and again, doing that in a place that is very difficult for security teams to observe.
You also highlight here, Mark, what sound like these LinkedIn-based phishing attacks. Explain those, Mark. How do they work?
Sure. So I think historically, when you talk about phishing or email scams, I mean, it is strictly that. It's something that's coming through email. And I think more or less that's what users have come to expect. If they're going to get scammed, it's going to be some, poorly worded kind of suspicious email that comes in with an attachment or a link. And really, that's increasingly no longer the case. So you mentioned LinkedIn. We identified an attack campaign earlier this year where an executive, a CEO, in fact, of a company we work with, was targeted through LinkedIn. He received a message from someone in his network, a first-level connection, about something that was very relevant to that company and to his work. And so he clicked on the link, along the lines of, hey, check out this investment information, this opportunity, let me know what you think. There was a lot of kind of sophisticated kind of hoops he had to jump through to validate that it was, in fact, him who was accessing the attacker website. And ultimately, the goal was to gather his login information. So, in fact, it wasn't the trusted contact that had sent this message through LinkedIn, but rather someone else who had compromised his contact's account. So this is a situation where not only is the message very, very convincing, but it comes from a trusted source, in this case, a trusted known contact. So very, very difficult to pick out. And again, very difficult for an organization to see what's happening inside of those LinkedIn communications, much less do anything to stop it.
How would you, as just a regular user, Mark, how would you defend against that?
Well, it's of course very difficult, and I think as just a user who maybe is less aware of these kinds of things, awareness is always helpful. And so I would say the same way that you might kind of pause and think before you go clicking on a link that you're unsure of the source, or opening a file attachment in an email that you're unsure of the source, if someone is trying to solicit some kind of action from you, whether that is accessing a website that maybe you don't trust or less familiar with, or particularly logging into your Google account or your Microsoft account, and you're taken from maybe the initial website to another website and then prompted to log in, that's where kind of your spidey sense should start tingling a little bit. And it's worth maybe picking up the phone or sending a text message to validate that that trusted person who sent you this message, that communication is in fact who they claim to be.
And finally, Mark, another one you talk about here, the Calendly phishing campaign. Walk us through that one.
Sure. So we identified another campaign this year, where attackers were phishing their targets, sending these malicious email messages with fake Calendly links. And many people use Calendly in their work, of course, to schedule meetings and find availability. And these Calendly themed phishing emails were ostensibly reaching out to schedule job interviews. And they were appearing to come from trusted brands like Disney, Lego, Unilever, with the enticement to click on this Calendly link to schedule a job interview. So kind of a couple of different things in play there. One, you had a trusted, recognizable brand. We're also kind of playing on emotions here, in this job market. Big opportunity for a job interview at a big company. Of course, that's very attractive. So in terms of that initial, what we would call allure, it was very convincing, difficult for people to kind of pick out. On the other side of that attack, the goal there was to trick people into signing into an account for Google Ad Management, which we know attackers often use to create malicious advertisements, so that when you go to Google and you do a search for, let's say, sports equipment, you're served up ads that will take you to these same kinds of malicious websites. So that campaign was pretty interesting from the perspective of that social engineering, very convincing ways of tricking people into clicking on those links, but also in terms of what the attackers are likely to do with that information once those accounts are compromised.
It's an ever-evolving landscape. You've got your hands full there, Mark. Thanks so much for your time today. We appreciate it.
Pleasure. Thanks so much.
That'll do it for today's Market Domination Overtime. Be sure to come back Friday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. The stock market, remember, closed tomorrow for Christmas, but reopens Friday with a regular schedule. Merry Christmas.